even before the crisis, a lot of indicators were starting to signal trouble.
Hey guys, welcome back to Library of Wealth. ARK Invest CEO Cathie Wood gives us her market outlook for the next few months and discusses the lack of trust currently in many financial institutions since the collapse of Silicon Valley Bank. Wood believes that investors may now be resorting to keeping their money outside of the system and warns that we've never seen market volatility like this before. She notes that interest rates have increased significantly in 1 year, which is a major shock to the system. However, Wood believes that the Federal Reserve is not acknowledging the stress on the banking system. She says the Fed's plan to raise interest rates too rapidly is already a huge mistake, as it will risk tipping the economy into an unnecessary and deep recession. Let's get right into the latest interview with Cathie Wood as she gives her market prediction for the coming months and what we can expect heading into the first half of the year. If you enjoy the content we do here, don't forget to hit the like button and subscribe to the channel.
If we are about to experience, some people would say soft landing. I find it hard to believe this will be soft, but soft or hard landing, what that will mean is inflation and interest rates are going to continue coming down, and the Fed will follow them finally. The markets always lead the Fed. So that could be what's going on here. If you remember what happened, our strategies, innovation-based strategies, they started underperforming in February of 21 when the whiff of inflation and interest rates going up with supply chain issues started. And the market just started discounting, saying, oh, interest rates are going to go up at some point. This category of stocks is not going to do well. The debt impasse still seems to be out there, and it looks like raising the debt ceiling, the imperative will come sometime in June, we think. So we'll have another few months. It doesn't seem like there's much movement at all. And yet we know that Republicans and Democrats don't want to go through another 2011 where the ratings agencies downgrade our debt. So we assume they'll figure it out, but so far, very little movement there. The one thing that is becoming clear, and this is really a throwback to the early days of my career, the bank crisis seems to be facilitating, in a sense, what we used to call crowding out back then. Really, the public sector crowding out the private sector. And how is that happening? Well, we're seeing deposit outflows from the banking system, so that's the private sector, into money market funds and especially treasury securities, a little bit of a flight to safety. So what is that doing? It's actually accommodating spending, government spending. And so we're watching this carefully. If it's accommodating government spending, what will it be crowding out? It does seem already that the commercial real estate space is one of the victims. So this could be just a slow-moving crisis. We don't know. But getting into monetary policy, it could be a slow-moving crisis, or are we talking about a hard landing? And I think, the markets are a little bit on pause now, trying to figure out, did the Fed and the FDIC come in and rescue the banking system from a run on the banks? So far, so good. But I do think the markets are stepping back and saying, is that all there is? What else could happen now? We all know, of course, it was the regional banking system. And it has highlighted two major mistakes that banks made. Both of them actually were very understandable, but they were mistakes nonetheless. And they made those mistakes in the middle of COVID, as the crisis was unfolding. They took a look at the Fed's forecast through the end of this year and saw that the Fed was forecasting that interest rates would go nowhere. They'd stay very, very low, move hardly at all. So it made sense back then to take the gusher of money coming out of fiscal stimulus and ending in bank accounts and put that in very safe, long-term, government-backed securities, yielding 1.5% or so. Remember back then, the Fed funds rate was 0 to 0.25. So it made sense back then. The first assumption they made was that interest rates would not go up very much, if at all, which is what the Fed was telegraphing. And of course, in 2022, and over the course of just 1 year, interest rates went up 20-fold. Never happened before. 20-fold, up to 5%. And that was a shock to the banking system because with such low yielding securities on the asset side of the balance sheet, it was very difficult for them to pay up for deposits on the liability side of the balance sheet. And so what happened? What happened was deposits flowed out and into money market funds, so out of the banking system.
Wood argues that signals such as credit default swaps and an inverted yield curve are indicators of trouble in the banking system. She's identified two mistaken assumptions made by banks during the last 3 years, namely that they would be fighting a depression and that interest rates would not go up, which led them to invest in long-term securities. However, interest rates have increased 20-fold in less than a year, which has sent a massive shock through the system.
Most of the statistics that have come out recently, that they were taken, or the measurements were taken pre-regional bank crisis. So I'm not sure we should pay too much attention to them. The positive ones were on housing, and I think it's because mortgage rates have come down since the long-term Treasury bond yield peaked last October at 4.3%. Finally, mortgage rates started to come down. So housing starts, permits, mortgage applications, existing home sales, and pending home sales all have done a little better. I mean, housing by many measures was down 40% year over year. So I suppose we shouldn't be surprised to see some rebound there. Autos they're still in recession territory at 14.82, but they came in a little better than expected. But other than that, even before the crisis, a lot of indicators were starting to signal trouble.
According to Wood, the Federal Reserve's quantitative tightening, where it is selling assets, has resulted in a decrease in the Treasury bond yield from 4.3% to 3.6% since October. She highlights that bondholders are the most focused on inflation, and managing long-duration assets is challenging when there is a fear of inflation and rising interest rates. On the other hand, she suggests that despite the Fed increasing the supply of bonds in the open market, the expected real yield has actually gone down. Wood believes that this is due to a flight to quality, where people are worried about the security of their assets and deposits in banks, leading to panic buying of government securities, pushing the price of bonds up and the yield curve down. As the government and financial systems continue to navigate these challenges, it remains to be seen how the Federal Reserve will respond to these concerns. What do you think about Cathie Wood's latest interview? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.